a lot of importers front ran tariffs, especially in quarter 1, by pulling in as much as possible. And so that distorted Q1 GDP numbers, but it did stock up inventories. And then two, some of these deadlines keep getting delayed or pushed around. And so even in this latest round, there's still kind of a time delay. And so I think that this generally takes months to start trickling out. In addition, there's no significant increase in the money supply during this period. And so what that generally means is that if there's higher prices somewhere, you're probably going to see either lower prices or just generally less volumes, which will contribute to lower prices elsewhere. And so that's different than, say, a stimulus type of inflation, or a rapid bank lending type of inflation. That's more of a sector specific type of inflation. And so I think it shows up generally more in unusual economic activity and potentially weaker asset prices than it does just in consumer price inflation.
Q1 GDP looked strong on paper, but according to Lyn Alden, that number was artificially inflated by a tactic most investors completely missed: importers front-loading goods to dodge tariffs. It wasn't organic growth, it was a panic pull forward. And now, the inventories are bloated, the real demand is weak, and the markets are pricing in a future that already happened. Worse, the Fed's tools to fix this are gone. Interest rates can't stop what's coming, and Lyn explains exactly why.
I would say nothing's particularly surprising about the data itself, just because we've had so many false starts, delays, stops, things like that. So far, the magnitude on the ground is not massive. I mean, it's material in the sense that we generally see, a multi-$100 billion annualized new tariff revenue. But when that's got like a 2 handle on it, so when we're talking about 200 billion in new revenue, that's pretty small relative to like 2 trillion in deficits. If you kind of round it and say the government spends 7 trillion a year and takes in 5 trillion, if you add 200 billion, it's not that it's immaterial, but it's not really a game changer. The latest round of tariff letters that have gone out, if they were all to be believed and enacted and then sustained, that would be something more like an $800 billion tariff revenue stream, which I would argue would be very material. And so I think that still is a market risk. And one thing I'm kind of observing is that, back in the April kind of earlier round of tariffs, there were market events. And generally speaking, you had a backing off from the administration, delaying some of these things. Now we're seeing that kind of, the second round of tariffs potentially go in. The market seems to be trying to see through it and say, well, probably these will get pushed back or negotiated, or this is kind of a strong opening volley for negotiations. I think one of the challenges is that if you don't have a market event, meaning that prices stay relatively elevated, there's not an extra kick of volatility or prices going down, then generally speaking, why would the president back down from his very strong negotiating stance? So it might very well take some sort of dislocation again to get some of the reprieve that the market seems to already be pricing in. So I think loss control is perhaps too strong of a word, but I think that the Fed's tools are much diminished compared to what they were before. And the reason for that, this is sometimes hard to phrase concisely, but basically back, for example, in the 70s, you had low public debt to GDP, and most of the money creation was from bank lending because the baby boomers were entering their home buying years, which was peak credit formation in a lifetime. So you had above target, above trend bank loan creation, and federal debt to GDP is pretty low. So if you want to slow that down, which is what Volcker wanted to do, he jacked up interest rates super high, and what that did was that generally slowed down bank lending. It made borrowing less attractive, slowed down the rate of money creation through the lending channel. Now it did blow out fiscal deficits because suddenly the federal interest expense was much higher, but because that was a low stock of existing debt to GDP. The general trend was that you slow down bank lending more than you blew out the deficit. So you did have a net slowing effect on total credit creation. You also, and this is the part that's less talked about, you strengthen the dollar rapidly and you basically impair various emerging markets that were dollar denominated and therefore make them less able to consume things like oil. And basically, impair the supply-demand balance for some key commodities, which left more for the U.S. But that's the third thing that's not really often discussed. But going back to that kind of credit creation channel, the problem now is that if you have very high public debt to GDP, like let's say over 100% relative to the 35% that it was back in Volcker's time, when you raise interest rates to try to slow down bank lending, there's two issues. One, bank lending is not above trend right now. Excessive bank lending was not to blame for the inflation we saw in recent years. And two, when you do raise interest rates, you increase the federal deficit now at a faster total amount than you slow down bank lending. So basically what that means is that the Fed's tools for slowing down total credit creation don't really work anymore. Now it doesn't mean that they don't have any levers. It just means those levers kind of work differently. They have more of a lag. They're not as powerful anymore. And I think that's the new environment that we're in. This could be considered a trial balloon. Basically, they put out a lot of headlines from directly from the White House and officials saying that they were maybe going to do this. Poly market odds spiked to something like 35%. At the same time, there was a pretty rapid, not a very large one, but a pretty rapid drop in the dollar index. And there was a drop in stocks and the long end of the Treasury curve, meaning that yields went up. That's generally not a successful trial balloon. If they had announced this news and the dollar was firm and yields went down, which is kind of what they want, then it's possible they would have gone through with the attempt. But because the trial balloon was basically saying that you kind of get the emerging market effect on your assets if you do this, it could have affected their decision. Hard to say either way what the counterfactual would have been. There's also legal questions. I mean, did they want that legal fight? Because the chairman can be removed with cause. And whenever you have a legal term like with cause, that's going to be debated if there was cause. So that could be a protracted fight that could be distracting from other things. So my base case is they won't remove him, but as headlines have kind of shown, it's certainly a possibility. The market's already shown what it thinks of it whenever these headlines flare up. So I still generally don't view long-end treasuries as particularly compelling. I don't think they'll do as poorly as they did over the past 5 years. So I've been a noted bond bear, starting from the time when yields were very low, and there were 18 trillion negative yielding bonds out there at the time. That major washout is probably behind us now. But generally speaking, with long duration bonds, treasuries, you're going to get volatility without a lot of return potential. So while they might be useful for a trade now and then, they don't trade the way they did during monetary dominance. And in general, they're just not that attractive compared to scarce assets. If someone wants a lower volatility asset, I do think that T-bills or other types of cash equivalents are interesting, especially if you expect, kind of intermediate term periods of volatility. So, for example, we talked before this very large in wave of tariffs. Generally speaking, you probably need to see some sort of market event to have some of them be pared back. So if someone wanted to make that trade for 6 months, then raising cash is probably not a bad idea. But in general, over the multi-year long term, my opinion is you want to be in relatively scarce assets. That's high quality equities, that's gold, that's Bitcoin, certain real estate that's not overpriced, and generally you also want to find entities that can short the currency. I mean, part of what makes corporate equities attractive is they've issued like 20-year bonds at 2 or 3%. So they're basically right along with you, shorting the currency and then owning better assets. Same thing for some of these Bitcoin companies like MicroStrategy that have, taken out like zero coupon convertibles, buy Bitcoin with it, and have like 5-year durations on it to give them a lot of runway. So those types of strategies I think continue to make sense in this environment. I generally like the short end of the curve more than the longer end, just in terms of risk reward. I generally use hedge more sparingly because hedge protects you in a very specific environment. So if you're worried about stocks going down, you buy puts, which is a hedge. Bitcoin and even gold are not necessarily CPI hedges, because if you get a spike in CPI, you're more likely to get a hawkish central bank, which is generally not always great for scarce assets, at least temporarily. But I generally view it as it's protection against long-term monetary debasement. So as currencies, the supply of currencies keep going up, you generally want to own scarcer things. And then for the scarcer things you own, you want to own best in class. So you want to own the best equities rather than the worst equities. You want to own the best commodities rather than the worst commodities. For the best commodities, generally speaking, that's gold. That's the lowest stock to flow ratio. That's the one with the most monetary premium. Bitcoin is the best in class for digital assets. It's got by far the biggest network effect, the most security, the most simple and robust design, the best kind of uh, structure to maintain its long-term decentralization. To answer your question, I don't view it too much as competition for gold for a couple reasons. One is I think that there's room for both of them.
Yeah.
Two, so far there's been different buyers. So central banks have been really, sizable buyers of gold as of late. Bitcoin is more like corporate buyers this cycle, to some extent, retail buyers. And the East is more active in gold markets, and the West is more active in Bitcoin markets, at least in this current cycle. So I don't view them as too much in competition. In addition, gold is much lower volatility. It's about 10 times larger of a market based on most estimates. If you look at like the World Gold Council, now we can audit the full supply of Bitcoin and know it down to the decimal point. We can't audit the full supply of gold, so we have to rely on estimates. But generally speaking, gold's about 10 times bigger. Obviously, has a much longer track record. Where I would say that Bitcoin somewhat competes with is other precious metals exposures, generally the higher volatility ones. So historically, if someone was bullish on precious metals, gold would be like the lower volatility one you might never sell. Whereas like silver, platinum, gold miners, these types of ones were generally considered more volatile plays on that trend. And I'd say to some extent they do compete with Bitcoin and maybe to some extent broader crypto, which is you have these more volatile non-fiat currency assets that now kind of fractures the liquidity. To some extent, where buyers have more choices than they used to. So I do think that Bitcoin to some extent competes with that, but less so with gold, at least anywhere in this cycle.
So what looked like economic strength in Q1 was really just a smokescreen, fueled by panic buying ahead of tariffs, not true demand. And now, the markets are stuck holding the bag. The Fed's tools are weaker than ever, inflation's moving in strange places, and gold is quietly positioning itself as the only escape route. If you've been watching the headlines thinking everything's normal, it's not. Now that you know the trap's already been set, you're going to need to understand the next critical move being made behind the scenes. Click the next video to find out what the Treasury and central banks are doing right now while no one's watching.